Roger Montgomery, we haven't spoken for a little while. Now, you see a real thematic pushing through this year.
Indeed. So what we've seen is in the retail stocks, we've seen good results up to the end of December, but a deceleration in December itself, so November and December. So
it's been a disaster for some retail stocks.
The second quarter of the first half, what we've seen is a deceleration in growth and a rapid deceleration. That's continued into January. So we saw that, for example, Nick Scali made those sort of comments, JB Hi-Fi, similar comments. I'm not surprised by any of that. We did know that the economy was slowing down, particularly at the consumer sector. The economy was slowing down at a rapid rate of knots, and it was only a matter of time before the RBA had to lower
We've got the governor
their growth
Phil
expectations.
Right.
So they lowered their expectations from 3.25% to 2.75%. And we also know that we saw foot traffic absolutely decimated in December, down 8% year on year in December.
What's this saying about the consumer?
Well, the consumer's pulling back. So why is the consumer pulling back? That's the big question. Now, everyone's pointing to all sorts of things. Uncertainty about the election. They're talking about wobbles in China, trade tariffs and all that sort of stuff. Really, it's much simpler than that. We've actually entered what I'm going to call the Great Australian Deleveraging. So we've gone from the GFC to the GAD, and it's only just begun.
And right at the level of the individual.
Right at that's where it's starting. That's really the nub. It really is the core of what's going on. People are simply pulling back. Now, why is that happening? It's pretty simple. We've seen massive declines in property prices. The Australian led the paper today with stories of suburbs like Box Hill in New South Wales down 43% or 46%. Red Hill in the Mornington Peninsula in Victoria down 31%. These
it's
are
like
big
a
falls.
mining town after the boom.
Now, the implications of this are, of course, that people have negative equity.
Yes.
They want to keep the roof over their heads. So what are they going to do? They're going to focus on the debt and bringing that debt down.
Yeah.
That means
meanwhile, utility costs aren't really coming down that much.
No, that's right. And all other spending goes to the side.
Right.
We're not going to go on a holiday. We're not going to spend money at JB Hi-Fi and buy that new television or the new fridge. We're just going to stay where we are. And a lot of retailers, for example, the Good Guys, Nick Scali, Beacon Lighting, those sorts of businesses, they were really benefiting from the boom in new house sales and new apartment sales. And they've plunged. New house sales now are down to 17-year lows. They're back to where they were in 2001.
So can I overlay this with the Hayne report on the Royal Commission and our big banks and what it's doing to the financial services sector?
Well, the risk is now, of course, that over the last number of years, and I can't tell you precisely how many years, but we saw business lending usurped by mortgage lending. So where business lending many years ago dominated the books of banks, it's now mortgage lending. So there's a very real risk if further declines in property occur. Not only will consumers just go on strike, and that's what the deleveraging is, credit growth grows at a slower rate than GDP, but what we're also going to see is we're going to see more negative equity, less spending and risk to bank balance sheets. The balance sheets are at risk and then let their funding costs go up, the Aussie dollar drops.
Yeah, but at the moment, you're not seeing this coming through on balance sheets at all. If anything, they're going down, their liabilities.
At precisely the top of the property market, the banks are recording the lowest provisions for bad and doubtful debts.
Yes.
Presumably, that's going to only go one way now, and that's up. So, I've always said to you, Ticky, when we've been on the show, that the last 5 years for the banks will look nothing like the next 5, and I think that's true. The Hayne Royal Commission really is just cleaning up something that needed cleaning up in terms of behaviour, but it can't stem the tide.
But that now
in fact, it could make it worse.
It puts a new mortgage brokers aside, and what Hayne's recommending there, that puts a new pressure on the big banks in terms of balancing customer service, relationship with their employees and duty to shareholders. I mean, I thought, for example, Matt Common's CBA result was almost to perfection because it wasn't, brilliantly, fantastically high profits.
No, you play down your profits.
It was just fine.
Steady as she goes.
It was very, very profitable, but it was pitched very much with Hayne in mind, I think.
Well, they're all searing from the spotlight being shone on them, and that will continue for some time. What's really interesting about Matt Comyn's comments were actually during the Royal Commission and talking about mortgage brokers. He actually said he'd studied the Dutch model, which of course is the Hayne recommendation that we get rid of trails and then we get rid of upfront payments.
And that borrowers actually pay.
We make the borrowers pay, user pays. So Matt Comyn said, he studied the Dutch model, is in favour of the Dutch model, provided there's, and he gave one olive branch, and that was that, provided there's channel neutrality. And that means if you're looking for a mortgage Ticky and you go to a mortgage broker, you pay a fee to a mortgage broker. But if you go to a bank branch, you also have to pay a fee there. I can't imagine what the legislation is going to be like to enforce banks to charge the same amount as a mortgage broker and not compete with them on that amount. Of course, he would love, by the way, the Dutch model because it's a free kick to the banks. What was once a cost centre for the banks becomes a revenue stream for them. And I don't think the Labor Party's actually thought that through when they said that they're going to adopt all the recommendations, and they've pulled back on that now and said in principle.
Interesting that Kenneth Hayne presumably should have thought that through as well.
Yeah, so what we've seen in the Netherlands, where this model exists, where users pay,
there's more concentration to the big banks.
Well, they pay about $3,000 to $4,000 for a mortgage, and users pay that. But what we've actually seen is not much of a decline. I think about a 5% decline in mortgage brokers writing mortgages. So there hasn't been much of a change.
Oh, right.
It's actually been fairly stable.
I've talked to others who've said that there is more of a concentration to the bigger banks.
The difference over there, of course, is that your mortgage is tax deductible and the fee you pay to a mortgage broker is tax deductible as well. In the UK, which is the model that the LNP and Scott Morrison are proposing, which is where we get rid of trails but we keep the upfront payments or review them in 3 years' time. That model exists in the UK now.
Is it working?
What's happened over there, it is working, but we do need some legislation around churn or over-servicing, because you can imagine, and it's happening in the UK, brokers will encourage you to switch mortgages because they get another upfront payment.
Right.
So there are pros and cons with both models. I suspect where we end up is somewhere in between. It'll be watered down somewhat, and I think the mortgage broking industry will have to survive. Otherwise, banks like MeBank, which is owned by 26 superannuation funds in Australia, what's their distribution model? Obviously, they can market to the superannuants of all those funds, but they also need mortgage brokers to be able to offer their products in comparison to others. And it's a benefit to the consumer to have mortgage brokers because it's a one-stop shop. You can look across different products.
Roger Montgomery, thank you so much. It was a very interesting convo. Thanks.
Pleasure.